Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, December 9th, 2022. It's 12:36 p.m. Eastern Time. So I'm starting the video, and I was going to break it down and do a separate one on the equity markets, and then updates on the usual stuff, the other assets classes that I cover: gold, commodities, bonds. I'm going to try to wrap this one, just keep it condensed. I've got some things going on today. I've been in and out, away from my desk, and back and forth. I need to go pick my wife up from the airport soon here. So I'm going to fire this one off and just kind of tell you the key things that I'm looking at here. First and foremost, remember we have the big, widely anticipated FOMC meeting tomorrow. I'm sorry, not tomorrow. Next Wednesday, 2 p.m. will be the announcement. And as such, we're probably going to continue to grind around. That was what I expected for the last week or so, and that's what we've been doing. This is the range we've been in, very clear. This was that last trade I got out to you day before yesterday for just a quick bounce trade. That target was hit last night in the futures, and that's also one reason I prefer to trade futures. That was about 11 o'clock here, and that level was hit, and then we popped that trend line as I suspected we might. That's why I give you those next levels. I'll get to that in a second, but then the reversal happened from there overnight and into the morning, and when the hotter than expected PPI numbers came out this morning, and so if you had QQQ, you could have never exited there. We gapped down this morning, but let me show you where we're at. So again, this is pretty big support here, 280, and that's wash, rinse, repeat kind of thing. When you recognize a trading range, you go long at the bottom and or cover shorts that you took down from the top and go to the top, sell, and then it became apparent right here. We didn't know, or I didn't know there was a range there, but I did point it out back here, and that's why we went long for that bounce trade. And there could be a little more next week. I'm not so sure. I think the easy money's been made off that bounce trade, but let me show you, or let me just say right now, my thoughts are this. The bigger picture, forget about active trading. If I know a lot of you don't have the time, effort, inclination, skill sets. So it's just the mode I've been in lately. To get these hit and run trades, get a percent or two on something, 3%, 5, 10 on natural gas, get out, and then wait for the next objective setup. But for swing and trend trading, this is the important thing here. This is my bear market rally bounce target zone. We hit the bottom of it recently, and I'm sticking with my plan, which was and is start scaling in there back into trend and swing shorts for what I believe will be the next leg down, and I'll continue to scale if we head up to the top of the range, but not above it. The top of the range comes in around 312 right there. That is my what I call likely bounce target zone, where we're most likely, if this is a bear market rally, to reverse from. So anywhere from the bottom to the top. And then this is my still potential. Now, at this point in time, we'll see if the charts dictate otherwise if and when we get there. But at this point in time, I don't plan to add. And one of the reasons for that, you turn off all the lines. The top of that zone is right here. It would take out this previous reaction high. So we'll see. You have this secondary trend line right here on a QQQ. And this is why I would give it coin toss odds and almost favor a post-Fed pop, slightly leaning that way, that pops us up to the secondary downtrend line. Remember, we already got rejected off this first downtrend line right here. That one just excludes that brief pop above, but it has nice clean reactions, 1, 2, through there, but enough to consider reaction 3 and then 4 recently. So that could be it. Now you have the key 200-day moving averages and that secondary downtrend line just above it, so that makes for a nice target. So again, any pop into that next week, not even the top of the range right there, it's about 303 here. I'll turn that level on just so you can see price wise, and of course it's the downtrend line and the 200 days. That would be an objective short there, as well as up to the bottom of the range. But for right now, let's just say this is the scale-in zone, the optimal scale-in zone. We already started here, and I plan to go home the day of the Fed, or go into the Fed meeting, I should say. It's during the day, with some swing short positions and room to add. And room to add means even if we don't get up there or there, we start going down, we start breaking support, then I will also add, especially once the Fed's out of the way. So that's it. And remember, on the S&P 500, it was a perfect tag of a very well-defined and clean downtrend line. This is my clean board where I turn off, all the other annotations. There's the all-time high, the end of the last bull market, the beginning of this bear market, and perfect reactions there. Not only that, you also have the key 200-day moving averages, the red and the blue line. That's where we got rejected off the 200 simple right there, and again rejected off the both of them as they come in and pinch together, and we're below them now. And if that's not enough, to me that's enough evidence right there to, especially in a bear market, to be, get back into shorts. Of course, rally into the trend line that would coincided with the top of the bounce target zone, or the bottom of the bounce target zone on QQQ. But you also took out the uptrend lines on SPY and QQQ off the lows, and looks to me like we're flagging here. So who knows? Maybe we get some selling later today or Monday, and that flag plays out like that. Certainly possible if we get some nervousness in front of the Fed. But either way, I just wanted to say that nothing's changed. And then last but not least, certainly not least, I'm going to turn off the RSI here, just park it to put up the PPO histogram. We already have the PPO line down here, and you know me, look at these crossovers. There's nothing in trading, buy or sell signals that are 100% effective, but this one's pretty darn good, and it's a trend indicator by its nature, the PPO. I like to look for divergences, but I also look for bullish and bearish crossovers. There's our bearish crossover. I've been talking about this for the last several weeks now, if not the last month or two. And I started with the sectors of the S&P 500 as well as the indexes. And at that time, a few weeks back, we only had a few, and the rest look imminent. When I say imminent, there's no guarantees, but it doesn't take a skilled technician to see when the PPO, the histogram, rolls over and starts moving down. Look at that, you almost always cross. Sometimes you bounce. I've seen it before where you look like you're poised to cross, and there's a case where we're the bearish, you got the whipsaw, but then it did stick. So that wasn't the whipsaw, it was that little red right there, because that was your crossover. And again, nothing's perfect, and I've covered this many times, but just look at the trends. Even if you use this purely mechanically, now I like to use it in conjunction with other things such as trendline breaks, rallies into resistance, support levels, bullish and bearish chart pattern breakouts, Fibonacci retracement levels, moving averages, all of it. But even since the bear market started, if you just use this, you were long mechanically. Every time you had a confirming crossover on the daily time frame, you went long. And then every time you had a bearish crossover like this, you went short. You would have captured the bulk of most of the trends and vastly outperformed the S&P 500. So I don't know. There's not much else to say. No, whipsaws are certainly possible, but the point of this is to update and show you that SPY has clearly made the bearish crossover. QQQ has clearly made the bearish crossover, also being rejected off the trend line. Small caps are clearly in the red right now in the histogram after crossing over. And then here's the 11 sectors of the S&P 500. Remember, recently we were looking for some crossovers. Here's a case where sometimes it looks like you're going to cross and you don't. Another one there that was highlighted about a week or so, a couple weeks ago. Never got the crossover, but now we clearly have it. So I'm going to just count them down. There's 11 sectors in the S&P 500. I'm going through these in order of market cap, and I'll do it quick. And same thing, you can look at your own charts, look at the trends that these captured. Bullish trend when it's green, bearish trend when it's red, right? Pretty simple stuff. So we have XLK by this metric on a sell signal. XLV as of today, if we unless this one can reverse, there's a bearish crossover. And so there's another one. And of course, again, I use in conjunction with trend lines. With XLV, this one's been topping out in this trading range for almost 2 years now. We had two false breakouts. Both of those rejected. Those are breakouts to new highs. And it's been my experience that almost always, very often, I'd say well above 70% at least, when you have a well-defined trading range and you break above or below it, you get a whipsaw. The next stop is usually the bottom of the range, and it's also often very quick. Once you fall back in the range after false breakout, it's usually a quick move back down to the bottom. So here's what I'm watching for here. Number one, does this PPO crossover stick? Number two, do we break this nice clean uptrend line? And then number three, if we do we fall back into the range? And if so, that would project down here. There's also a long-term trend line that comes into play. XLV, which is the healthcare sector ETF, is the second largest sector in the S&P 500. So that's one to watch. It'll definitely, put some pain on the indexes. And to me, again, the sell signal looks likely imminent. There are no guarantees, but we'll watch for that. So that's number two. Again, 2 for 2 red, 3 for 3 XLF financials, and financials just put in that big divergent high, negative divergence right here. You can see it on both the RSI. I don't have the RSI up here, but the PPO is clearly in red territory. 3 for 3 so far. Sell signals via the PPO, daily PPO. XLC communication sector, which is mainly Meta and Alphabet, those make up almost half of it, still fired yesterday, gave us a bearish crossover, making it 4 for 4 so far. Again, the top 4 largest indexes. Number 5 is XLV, also red as of this week. We gave us a signal Wednesday, and it's solidly red today. So there we go, 5 for 5. Is that the 5th or 6th? KVFCY 5. All right, and XLI Industrials fired way back here, clearly red after rolling off that divergent high right there. And trendline break. XLP clearly red as of this week. So this is it. We broke these trend lines. Remember, this is not mere coincidence that you had the market itself, QQQ and SPY breaking below those trend lines, but a lot of indexes too. And then they hit their first support level, but they're on sell signals here. And I have seen you get these sometimes you get them and it's a whipsaw and then the PPO crosses back, but take it on face value. This is a lot of evidence. So there's already every single sector up to here, which I think I just covered the 7th one. XLE is next. Energy sector, we shorted. That one's been a short. It was almost just a hair above T1 yesterday. I should cover it, probably maybe bounce up here. I always talk about the reason I list multiple targets. And by the way, I still maintain and have all along the second and third targets, T2, T3, and then if and when we start to approach there, I'll let you know if I'm going to extend it to T4 and T5. That's why it says potential. And the reason I list multiple targets is each target has a pretty good chance, above average, of having a reaction up on the initial tag. That means on a short trade or something going down, you have a reaction from above. And I define a reaction, this is just me, I make up a lot of terms in trading, maybe other people use these terms, or I don't know. But a reaction is, I consider a bounce when you're going down, or a consolidation. If you're going up, in a rally and you hit resistance, it's either a consolidation or a pullback. And the analogy I like to use is you throw a tennis ball at a brick wall and that's going to bounce. That's certainly a reaction, right? And you throw a sack of potatoes at a brick wall and it's going to just stop and stay there. And that's what we did with XLE. Obviously the consolidation without a bounce in price, more so in time, we had about 3 days trading at 4, is the more bearish of the two. So it's consolidated enough that if it wants to take it out, can. I'm suspecting we're probably going to bounce here in crude. We're certainly bouncing. Remember, I threw natural gases along out the other day, and those things together right there are going to be that what I call the bane of Powell. And I believe this is how this bear market's going to play out for years. I hear these folks on CBC come out. I heard a guy today, and I've heard this before, and they cite the average length of a bear market. Hey, maybe they're going to be right, I'm going to be wrong, but I would highly caution you against going over statistics in recent years, because I can sit here, and I've done this for months, and make a fundamental and technical case that this bear market we're in has only started, and it's going to be much longer and prolonged, much closer to what we saw back in the late 60s, early 70s, what Japan saw in the 90s. and beyond. And therefore, if you're, thinking that it's going to be over, 18 months or so after it started, hey, maybe that's the case, but maybe not. So be careful there. And, we'll let the charts be our guide. I'm not married to any one thing right now. It's just, as time goes on, uh, it looks more and more that that's going to be the case from many reasons, fundamentally and technically. So XLE put in a divergent high, negative divergence moving down, and whether we bounce or not, point of this was to show you solidly red PPO crossover. There was your PPO crossover, and it's been moving lower since. It's a great trend indicator. Bearish trend most of the time this year. It's been bullish. This has been the strongest sector in the S&P 500. And again, you can trade this mechanically and look at, you would have been most of the time long at the right time, short at the right time, just using that PPO histogram. Here is XLU. It's not going to move the needle because the weighting is very low. But look, again, it hasn't crossed over. But if you had to, place a bet here with somebody and say, okay, within the next few weeks, is this going to stay green or turn red? Well, I think your safe bet's going to turn red when it starts heading down. There's a whipsaw right there, but one red day and it went back up. So it happens. But again, I said that before and I'll say it again. Nothing's 100%, but this one's 90 something percent, just looking at it, taking those signals. And even if you take the whipsaws, guys, keep in mind, you can mechanically trade this right now in this trend. And even if you just mechanically, without second guessing it, the day you get a green close after red, you cover your shorts and you go long, well, you would have done that, and the very next day you would have then turned around, recognized you got whipsawed, you would have sold the longs out of, after the next day, and got back in and caught that whole move down. And then if you followed it right there, you would have gotten out of your shorts and you would have so far caught this whole move up. You'd still be long, waiting to close those longs. So again, now all the better when you can time it with or add a sell signal such as a nice clean trend line break like that, right? All right, so that's it. XLRE red crossed over this week as well. That's it. So the story is, not to beat a dead horse, but just looking for additional confirmation, because in a bull trend, this is a bull, bear market rally, we'll call it. You want to call it the start of a new bull market, doesn't matter. The near-term trend for the last couple months has been up, and that's why I do these videos and talk so much. You want, pretty compelling evidence, because most people don't do that. I am a trend. I position and try to time the market. I try to get in right at the top or as close as possible, and the bottom. Most folks chase trends. They want to see an established trend and then buy into that trend, and I get it. That's their own style of trading. But when you do it, you got to be pretty precise, and especially after a pretty strong trend with a lot of momentum, and that's it. So the takeaway again is, I think it's still an objective time to be closing longs if you haven't done so, swing and trend longs, or add or scaling into adding to short positions. And again, I'm not going to go super heavy short into the Fed, but as of now, I plan to. And I added some swing shorts today on this bounce up on in the major indexes. Sorry, XLB. Finally, that's it. So there it is, guys. They're all red. They all had crossovers. Either it's going to be big whipsaws, and if anything's going to do it, it could be the Fed, or maybe Santa Claus comes and with his sled last minute and gives us a Santa rally. But you can sit there all day long and think, well, what if you try to trade reactively, waiting for the Fed to do something, waiting for this or that or the other, it's not going to work. You got to get in front of these things, and the case to be short now, in my opinion, has been strengthening and continues to strengthen, and that's it. So let's not spend any more time on that. NQ, NASDAQ 100. This is a 60-minute chart I just flipped to. Remember, both QQQ, SPY, as well as NQ, the primary trend lines, uptrend lines, were recently broken. We hit support, we bounced, we gamed that bounce, and I think that's it. And I can draw this trend line off the top, or I actually had one here. Let me extend it. It's real hard. I'll zoom in on this chart 1 second for you. I know you probably can't see it good in the video, but that's pretty much it right there. Let's tighten it up a little bit. So we've rallied back into resistance. I would put a line. I'm going to take this line, drag it up just a hair to get these two reaction lows, and that's what capped it. And I do that all the time. You know, I always say the charts are dynamic, and therefore so is my analysis. So I will shift, modify trend lines to make them fit the most recent reactions, and those are two distinct reaction lows. We have a reaction high there, so that's resistance. All I can say is near-term bullish if they pop it, but odds favor rejection. And with the Fed coming up and a weekend coming up, and today I wouldn't do a whole lot, and we're going into a weekend. Even futures traders now have that extra overnight risk that regular, ETF traders and stock traders don't. Going down to the short-term charts, last night I told you we hit. This is where we went long right there, day before yesterday, to game that 2% rally up to the downtrend line. We got there. And I said, look, if they run and pop it, it'll probably be a quick pop up here. So that's what I wanted to point out. That I told you 1745, 11745, and then the comparable level on ES. And you can see we got rejected hard there. So, and it wasn't just that. You also had the negative divergence. I had that drawn out last night, so just extended that line. So this is a 15-minute chart. That's what that last trade was based off. So you had that little wedge there, broke down, back tested. Big rejection right down to that 11,529 support, bounced, and this is that level of resistance I just gave you on the NQ 60-minute chart. Again, that line was there last night. And then ES is the S&P 500 futures, same exact thing. I gave you the downtrend line we were approaching last night. Said if it popped, 39.90 is going to be your next resistance, and it was a pretty good one. And that's what they did. Popped it, cleared the stops, and then boom, rejected. And now we're back testing the trend line. So this is my preferred scenario into throughout today and into probably next week. I think that's most likely, but remember, Fed week, it's going to be choppy. ZB, okay, so a week or so ago, I told you that I just took profits on the last of my swing or trend positions in 401k. I had a bunch of money in bond funds, and bonds had, that's back, started scaling a little too early, admittedly, but stuck with it, kept adding, and was adamant that the bonds had the best risk reward profile of just about anything out there. And it did. They played out very well. It's been almost a unidirectional rip up, but started scaling into some shorts yesterday. And added today, we had a little, this is a minor wedge, minor uptrend line. This is a 60-minute chart, sorry, by the way, on the ZB, the 30-year bond futures, which I didn't mention before. Big negative divergence, but I've been updating this one lately. And then this is an uptrend line right here, and then a support zone. So you probably can't see it. I'm drawing so many lines. But we're coming up on a support zone, a price support zone that runs from about 129.246 to 129.128, and this potential uptrend line. Why do I call it a potential uptrend line? Because there's only two reactions. In my book, it takes a third distinct reaction to validate a trend line, because any 2 points can be connected at random. But we'll probably get some buyers step in here, I guess. Would be my guess. But when you look at the scope of the divergences, let me go back out. Remember, this is a 60-minute chart. My lines just went away because I zoomed out too far, but I'll redraw them for you. You can see we've been diverging for a while here, so I think we'll see a little profit taken on bonds into the Fed. And of course, the thing I focus on, put the biggest weighting into, are the yields, as much as the bond prices. Let me just change my indicators back. Let me park that PPO histogram, pull up my RSI back on there, and go to TYX, the long bond, 30-year bond yield. There it is. We put in this divergent high. We got the most overbought we've been since all the way back here in early 2021, and we broke. This was a sell signal here for yields, which was a buy signal on bonds. So this was the rally in bonds. We shot through here, but we're at that previous reaction high right there, and that's where I expect a bounce. And this will probably, so short-term bounce, and then continue on. Eventually, bonds will continue to rally after, I think, a little correction here leading into the FOMC meeting. And then TNX, you want to watch the 10-year yield as well. That one is also at support. trend line, just right around the trend line support, and then price support, which is that same previous reaction high right here. So that's it. Probably get a little bounce in yields, which means a little pullback in bonds. And then at some point, I think the rally will resume till we hit this primary trend line. And so that'll be another time to be long Treasury bonds as yields fall, and then to get out and then reshort them, go back into swing short positions again. Yeah, ZN, if you trade the 10-year, there's a little less volatility because of shorter maturity, but there was a little breakdown there. Same thing, 60-minute divergent high, just like CB, and it's coming up to support now. So in fact, I'm gonna click a button here and cover. I was looking for a little more. I've got an order in, but I'm just gonna pull it now, cover my CB position, and boom, covered. All right, let's see what's next. And that's because also we're heading into the weekend. I like to lighten things up before weekend. Oh yeah, the gold and the US dollar. Let's go there. EUR, let's start with the dollar and the euro. I like to use the pair, euro, US dollar. I've covered this extensively recently. This is a primary downtrend line, which has been a price target, a swing target, since all the way back here off this divergent low, positive divergence, which is bullish. Then you had the first minor trend line breakout back test, and we run up here and we have negative divergence. And so this is where I recently said, you know, closing out swing positions in gold and silver and gold. And I still think we're going to get that. I think we're going to get a little pullback here. You know, most likely, I'll tell you this, it's been resilient. Remember, there's two ways to have a reaction, and so far since the euro and US dollar hit this, it's been consolidating. Now that's not very unexpected, because remember, again, we're heading into the Fed meeting. I told you the markets usually go into a holding pattern. That's why the stock market's been in that sideways trading range for the last week or so. That's why the currencies have been, everyone's kind of on hold. Who wants to make a big move? You know, what trader wants to put a big bet on the dollar, a big bet on the euro right front? They're going to wait and see what happens. And, you know, you may see a little nervous profit taken on one or the other coming in. But there's an uptrend line. So this is a bearish rising wedge. That's resistance. My guess is, even though I'm longer term bullish on the euro, longer term bearish on the dollar, remember, this is where gold goes proportionally in this whatever direction. It has a positive correlation. So this has been that lift in gold that we wrote up, and I think this is going to break to the downside. I wouldn't be shocked if it broke up to the upside. Sometimes that happens when you're coming off a bottom and a strong downtrend that's finally ended. And again, the case can be made there, but not the nail isn't in the coffin yet for the dollar, because this is my weekly chart. We have this major long-term resistance zone. We're still right at the top of it, and on the weekly chart I have the downtrend just a hair above. That's the way I have it drawn on the weekly. But if the euro and US dollar can pop this, then this whole thing, as I suspected it would be, proves to be a fake down or a false breakdown or bear trap, and that's very powerful. That's what I think will happen. It's just, is it going to happen right now this week after the Fed, or are we going to get a little pullback first and then power on through there? I'm kind of leaning towards that pullback, and that would give us a little more weakness in gold and silver, and then break out. And this is where you definitely want to be long gold and silver once this level, that downtrend line on the weekly is taken out, because that will confirm that this was a false breakdown or a bear trap. Right now, we're still pushing the upper limits of that former support, now resistance zone, which means essentially all we're doing is back testing it. So maybe the trend, you know, this was a major breakdown in the euro, and you know that breakdown hasn't been reversed yet. We're just back testing, and so you know, it goes without saying, you know, there's the rally in gold. It's right in line with the rally in the euro. It's no coincidence. You know, we saw the same thing. We had, just like the euro, we had positive divergence in gold. Then you had this, gold already had, and that's why I remain longer term, even intermediate term bullish gold, just near term bearish, because you have negative divergence right here. You have a little rising wedge, just like the euro. And if this wedge breaks down, it's probably going to give us a correction. Any pullback back to 161 roughly, or 158, are great buying opportunities. I do not want to see gold drop below 158, because that to me was a huge level. It was a major support level, and it made this turn into be a giant bear trap. And again, a bear trap that was fairly predictable with the positive divergence. And once we gapped back above that level, then it was a bear trap was, in play. All right, so and again, that has power. Where I'm going with that, and that's why I'm going back and forth so much. That's a powerful thing in technical analysis. So it has the potential to burn through these divergences and see gold keep going up here. But time, at least caution's in order now. Nothing heavy. Long term, if you're bullish, I'd probably stick with your swing and trend positions, and just if you have room to add on any pullbacks down to, but not below 158. That's my trading plan. SLV, silver's coming up to this downtrend line here, right here on the silver ETF. SLV, like gold, it's got some negative divergence building on the daily time frame, and so if the euro has a pullback, then silver's probably going to pull back. Pull back to 19 would be a great level to buy, and there's even support a little above that up here about 1982, anywhere there, and obviously you want to see it hold the recent lows, but all looking good for now. Same with the miners. I don't, guys, it goes without saying, and I'll tell you otherwise, there are periods where the miners underperform gold and silver, but usually they're like a leverage play on gold. So unless I state otherwise, there are some unique situations, particularly broad market, heavy sell-offs in the broad market where gold stocks get sold down with the market, even if the gold's going up, but that's rare. And so to be bullish and long gold and silver is to be bullish and long the miners, because they tend to go up more, and we already hit the first target, and we're halfway between T1 and T2. But again, if gold and silver pull back in the next week or so, so will the miners. And if you can recycle back in or add some, 27.31 looks like a great re-entry point if we get there, all the way down to but not below 26.12. But really also more so what gold depends on what gold and silver do, particularly gold. So all right, you're up to speed there. Last but not least, crude oil. USO have been bearish, kind of intermediate term bearish on crude for a while here. We put in that big divergent high right there, negative divergence. Then we broke this bearish rising wedge right there, back test, and we've been stair stepping lower. Then we put in a divergent low, we had a rally, then we took out this trend line, blah, blah, blah. And here's a target that I've had for a long time, long time. Swing target, all the way from the highs. Swing target 58.60 and the uptrend line. Well, guess what now? The uptrend line is coming in first, and we're close, very close to the uptrend line. And so at this point in time, I think crude's starting to look good for a potential bounce here. In fact, what I need to add, if we reverse soon, you have for the first time in a while positive divergence on both the PPO right here and the RSI. So let me show you something on the 60-minute chart of crude futures. They've been in a downtrend, but they look ready to pop. This is a 60-minute chart of CL crude futures. You've got a downtrend line right here, and from this point right here, and really all the way back here, we've been diverging. Divergence, and it's not like the divergence doesn't work and play. It does. You had a divergent low there, you popped. Small divergent low, the divergence got bigger to this point right here, and a bigger pop, right? And that was right there. Then we got even bigger right now, and so if we pop this trend line, and especially pop that next price resistance level, we'll call it a price target if you want to take a shot today, kind of a pot shot. We're in a downtrend, but you can start scaling in. I took a small position I'm going to take home for the weekend, but I plan to add on a break of the trend line, and then again on a break of 72.90, and that would bring us up here. So yeah, anyway, and that would also, this is again what I call the bane of Powell, these commodities. He's gonna, they go down, stock market gets all giddy, and giving them credit, the Fed did their job, and as soon as they start, taking their foot off the brake, you're going to see buyers step in and run commodities up, and then the market's going to react because inflation's coming back. All right, last but not least, natural gas. Find that one for you. Okay, natural gas. I already had on a 15-minute chart. I made a little trade this morning, quick one, but just a pullback trade here. We have a downtrend line it just hit, but the bigger picture, as I mentioned the other day, was bullish, and that's not good for the stock market. We had a trade here. We had a divergent low right there. Went long somewhere in there, and was targeting this level here, 61.30 and/or the downtrend line. So yesterday we hit 61.30. I posted this chart here yesterday. We hit the 61.30 level, and there's my arrows. Pulled back to 5.803 or 580, and then bounce from there. Now, I didn't list that as an official trade, but obviously if I give you arrows, that's where I think it's going, and that was yesterday, and grab that chart back, and that's exactly what natural gas did. You got to exit at 580. The drop was, what is that, 6% or so right there. And so you've sidestepped a 6% give back or turned it into a 6% quick pullback trade. And then you would have reversed there for the bounce and made another 10 or 12% since then. That's it. So I just showed you on the 15-minute chart, I had the trend line a little higher. So I'm going to pull that up here now. And that catches that reaction high. And so pretty much we got rejected there. So no opinion right now from where we go from here. But let me go back to that and speak to that. But again, as far as inflation goes, remember the whole premise of the going long the other day, we nailed the bottom. We were right on this trend line here on UNG, which is a natural gas ETN. Does a pretty good job of tracking natural gas. Not perfect. It's an ETN. Futures are always a way to go, in my opinion. But if you don't trade futures, there it is, and boom. So it's been a nice pop. And this would indicate very likely the next leg up in natural gas, and that's going to be no bueno for old Mr. Powell there if natural gas works its way up in the coming weeks to months, especially if crude goes up as well, because those have the biggest impact on inflation, or right up there with housing, some of the biggest impacts. All right, I think that is it. Yeah, let's wrap it up here. All right, I'm going to wrap it up. This will probably be the last video for the day. I've got to run out now, and we'll pick it up tomorrow. If I see anything big over the weekend or anything, I'll get out to you. Otherwise, we'll pick this up on Monday. This has been Randy Finney with Right Side of the Chart. Have a great weekend.